Welcome to Subramani. I'm going to talk about two concepts, REITs and investment trust, REIT and INVIT, right? Which is infrastructure investment trust. So, what is a REIT? What happens is you could do small real estate deals, which many of us maybe, landlords do that, right? They give houses on rent. But what happens is when and individuals go borrow money and buy houses for themselves, but if they have to take on rent, then they have to go to some landlord and take it on rent. That is the current situation in India. Largely, Indian real estate is held by individuals mostly, and big rental properties are not available. So when a 22-year-old migrates from a smaller town to a bigger city, he goes and looks for a landlord who will help him get a house and or an agent. So here he goes through an agent, and the agent takes him to a landlord and says, this man has got 2 flats, 3 flats, 5 flats. There are people with 100 flats. So, which could be a family group of 3 brothers, their children, etc., who own a lot of flats in one locality. Largely, this is the big landlord. Otherwise, there could be small landlords having 1 flat, 1 house, or things like that. So, all these combinations exist. Right now, it's a very, very unregulated cowboy style market where nobody knows at what price the deal actually went through. There could be an element of cash, there could be an element of check, there could be a big deposit, low rental, or there could be a low deposit, high rental. All these combinations happen, and you have to only guess, negotiate, and you have no clue at what rates the real transaction happen. In the same building where you are looking at, there could be an furnished flat which is available for 50,000 rupees, and an unfurnished, unkempt, landlord who knows nothing about the market rates who is giving at 25,000. This is the kind of gap that exists. This is a real estate market. Now imagine somebody coming into it and saying, okay, I will organize this market, I will buy property, I will buy office properties, I will buy housing property, I will build bridges, I will build shopping malls, I will do all this, and I will give it on rent. So it's fairly obvious that it has to be a big organized company which is into infrastructure, which means it has to have money. So an HDFC or an ICICI or an SBI can launch a fund like this and say, okay, this is the HDFC REIT fund, and we will do all the construction. Now obviously they also will have a limitation. Maybe they will have 1,000, 2,000, 5,000 crores, but beyond that they will also have their limitation. So at that stage they may say, okay, we will put all these assets in a trust. You could own a portion of the trust. So you and I with say 1,000 rupees can also become a part of that. Well, 1,000 is wrong because the minimum investment required in a REIT is about 1 lakh of rupees as of now. It might go up or it might go down depending on how popular it gets. If it gets popular, then there will be demand that the ticket size be reduced. If it is not very popular, it will remain at 1 lakh, which is not too big, it's not too small, but yes, it keeps out a lot of small people wanting to participate in that. So what is this organization? Let's call it is a trust. First of all, you see real estate investment trust or infrastructure investment trust. So it is a trust which owns a lot of money, or it tries to acquire a lot of property to be given on rent. This is largely the mandate of the investment trust. So they keep buying property, giving it on rent, and what is the advantage for you over buying a property? Buying a property could involve a lot of maintenance. Let's say you're 45 years of age, you bought one property and it has done very well, you're getting good rent, so now you're enthused, so you buy one more, Suddenly you turn 65 and you find that you've got 12, 13 properties. Running around from each place, looking at the land, the tenant calling and saying there is no water supply, the electricity is a problem, or ye bulb fuse ho gaya, ye khidki toot gaya, this has to be replaced. You will run into administrative problems and your children may not be interested, right? So it's not very easy to do real estate as a business. It's not impossible, but it is difficult because some tenant may leave, you may not be able to find. COVID strikes and the guy just goes away, or a guy says, sorry, but I can't pay rent, right? So the risks are too high, and knowing your home bias, the chances are all your properties in one location, not even one city. You're not even only in Bombay. You could only be in Bandra, or you could only be in Ghatkopar, or you will have a very localized impact. So anything happening in that location could impair your assets very badly. But if I were to invest in, say, a REIT created by a landlord, so what happens is, here is the investment trust. Let's call it the HDFC investment trust and HDFC REIT. So they launch a REIT and they have, say, 20,000 crores to invest. So they go and invest a little bit in Orissa, a little bit in Gujarat, in Delhi, in Gurgaon, in Bombay, maybe something in Bandra, something in Mira Road, something in Navi Mumbai, something in Chennai, Bangalore, right? So they have a bigger mandate. They have more properties to buy and sell. So which means the risk is reduced. Exactly how the risk is reduced by creating a diversified portfolio. With 1,000 rupees, what can I do? I can do an SIP in a fund which has got 50 companies. So in every company, I'm getting a small portion. So here is a REIT which is invested in so many places, and I get a portion of it. What else do I get? Currently, it is structured in such a way that the REIT collects the rent, deducts its expenses, whatever it is, and gives it to you, and about 90% of what is their income has to be repaid has to be paid as dividends. So you will get the dividends from them. So sounds very good, right? It is better than buying your own property, running behind it. You don't know how it will be taxed, when prices go up, what deductions you will get. You don't get into all that. REIT is like a mutual fund as far as you are concerned. You go buy it, and you enjoy the dividends. Will you get capital appreciation? Yes, of course. When the property prices go up 5 years, 10 years, 20 years from now, you will get. So what do you get in a REIT? You get capital appreciation when the property prices go up, but definitely you get rent, right, which is in the form of dividend as far as you're concerned. And current situation is the dividends are tax free. Now wait a minute, don't get excited. These are all the features that I told you. What I like about it is it gives you diversification in real estate, which is otherwise not possible for you to get. Now let me tell you what I don't like about a REIT. In India, unfortunately, real estate pricing happens very, very funnily. The return that you get on giving a property on rent is very low. So let us say on a whole, you get 10% return in real estate. Let us assume for a minute, out of which only 1.5 to 2% maximum you get in terms of rent. The remaining 8% you hope to get in appreciation. Now, if the property does not appreciate for 5 years, you getting nothing. And in a REIT, how will you capture the appreciation unless the trust decides, oh, this price has gone up too much, so let me sell it, let me realize that money, I'll buy another property, and my rentals will go up. I had 100 units of property given on rent. I sell this in Bombay and I buy this in Pune, and I get 200 units, and from that my rental income will go up, and therefore I will be able to pay higher dividend. This is the only hope, or the fact that it is a listed REIT, so the price goes up, so I am able to sell. Those are the two things how you can earn money. Now, let us not get confused, because mutual funds are very successful. Don't assume REITs will be very successful. The reason why mutual funds, especially equity mutual funds, are successful is because the NSE and BSE, with some help and stick, carrot and stick policy by SEBI, have developed a robust secondary equity market. So in an equity market at 11.55, if I know that 100 shares of Reliance were bought for the fund, or 1 lakh shares, doesn't matter, I can check even with the regulator, in the sense National Stock Exchange or Bombay Stock Exchange. I can check with what price the transaction happened. So much of transparency is available, right? So I can go and find out what price the fund manager has bought. So the chances of corruption in execution is at its minimum, right? Almost you can eliminate, especially for a big company. It is impossible for one fund house or one fund manager to manipulate the price, or even for a group to manipulate the price of a big company on a regular sustained basis. It's very, very difficult, because mispricing will be caught. Somebody will do a F&O deal, somebody would go and just buy if you try to sell at a lower price. So it is almost impossible to do a bad execution. You can do bad research, but you can't do bad execution. Whereas in real estate, first of all, real estate does not have very great reputation, as builders and all don't carry great reputation. Yes, one Godrej, one Tata, and one Oberoi has got a good name. You can pick up a few Shobha builders in South, so few of them have good names. Real estate, and there is other possibility of corruption, that the manager in the trust gives a sweet deal to a friend of his. There is almost impossibility for you to find out, because not every deal is recorded in some place. Forget not being market discovered. Rents are not discovered by the market. Yes, rents are discovered by the market. For everything there can be a justification. Say, oh no, that office was too big, so the rate is less. The office was too small, so the rate is less. But in the month of April, this was the best we could do, because we had already kept it shut for 3 months, 6 months. There is no way how you can look at whether every deal has been done right. So corruption in the system is almost impossible to remove. Secondly, rental yields are very low. You have to only hope on appreciation happening, and therefore getting a good deal. Real estate is also notorious for longish spells of nothing happening. Let's say for last 5-6 years nothing has happened in Bombay, but maybe something great has happened in Hyderabad and property prices have doubled. So whether you are in the right places, who will make those decisions, who will make those choices, so it's very difficult to say. So what is your choice? Your choice is if you know the pricing at which it is happening. For example, it's a infrastructure investment trust which owns an airport which is already built. Chances are you will make a lot of money as the airport ages and the charges and all keep going up thanks to inflation. If the rates at which the services and the rents inside for the shops, for the landing charges, etc., if they go up at a rate greater than inflation, and if they can keep their costs very low, then you will make money. To me, the reason to invest in a REIT today is to take some money off the table of equity and put it into some REIT, not because you're going to get it, not because it's a great deal, but even if it's a place where you can preserve your capital. And in equity, let's say equity prices fall, then you will say, okay, this asset has fallen and this asset has not fallen. That is the only advantage I see as of now. The income from that is tax free, but then the yields are so poor that you're not going to make too much money. I would not advise you to put money in REITs and INVITs today unless you see a very good yield. Suppose you see 11.5% yield. It is attractive because yield, remember one more thing, unlike in a direct equity or even in a mutual fund, forget a mutual fund, in a direct equity there can be steady dividend. To me, steady dividend is not as attractive as rising dividend. So I would rather put money in a rising dividend company even if the yield is low, because I know in 2-3 years it will catch up, because the dividends will catch up to market price, whereas I have bought it at a lower price. So the share price will go up and the dividend will also go up. And anyway, dividends are today to be taxed in your hand. So you're at the 20, 30, 40, 43% slab, whatever slab, you're going to pay tax on that. So there is no great tax advantage that I would think in a corporate. But in case of REITs, the chances are if you get a very good yield, go and buy it, because you're going to get that yield for a long period of time, because the base price is not going to change much. Hopefully the price won't fall because the price is captured because of the yield. So if you're getting 11% yield in a country where G-Secs are at 6-7%, 11% is a good yield, because chances are, yes, you're taking the risk. The yield may fall a little bit, but still there is 4% of moat that you have built in. It may not fall much, it may not fall that much. The prices should really fall dramatically to wipe out this yield. So if you get good deals, buy it. Very unlikely that an IPO will be priced at 11-12% yield. It is more likely to price at 7%, 8% yield. So don't apply in the IPO, wait, and then when the price falls, you can buy. And prices will fall for any asset. Suddenly they'll say, oh, real estate is doing well, so REIT prices will go up. And suddenly when they say real estate is doing badly, REIT prices might come down. So do an SIP, buy regularly. If you can lock in at high yields, lock in. Don't expect growth to happen there. Even growth has to happen, it will happen over very long periods of time. So this is my view on REITs and InvITs. Personally, I don't like the current structure and I have not invested because I am very worried about fund manager corruption. I'm not so much worried about fund manager corruption in equity markets because I understand equity markets, so I can smell corruption, I can touch corruption, hopefully find out about it much before the market finds out and exit in case. Anyway, I stick to 2-3 fund managers whom I know personally are clean. So to me, it does not really matter. REITs, for me real estate stinks of corruption. So I will not invest, but that's my call. You have to make your call. Thank you.